Hello, good afternoon or good morning, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator at our new time, which is 12 p.m. Eastern, on Tuesdays, Wednesdays, and Thursdays. This is our first episode at the new time. Thank you, everybody, for tuning in. I see some comments already coming in there. You can feel free to drop some comments there in the chat. Just waiting a moment here to go live on all the different platforms, but we do appreciate everybody tuning in nice and early. So it looks like we're live. We'll go ahead and get started. You can keep putting comments there in the chat. You can also drop any questions you have in the chat, and we can definitely answer them after the presentation. But we'll go ahead and get things started here. All right. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern now is go through our loan officer training topic here. So, Jose has a presentation to talk about how to structure 5 to 10 unit property loans. This morning, we talked about these on our Daily Rates Live show and had some rates to show for them. And now we're going to talk about how to structure those loans. So I'll turn it over to you, Jose. Go ahead.
Good morning or good afternoon, everyone. Thank you for joining us for today's training on how to structure 5 to 10 unit property loans. These are one of our favorite product lines because, they say the niches are in the riches, right? And there's very few loan originators and companies really trying to specialize in this niche. We love it. It falls right in line with all of our Dscr products, right? Our 1 to 4 unit. This is our 5 to 10 unit. We have them also for 11 to 20 units. So a lot of good products out there at the Mortgage Calculator. So let's jump right into it on how to structure a 5 to 10 unit property loan. First, let's get into what actually are we talking about when we refer to a 5 to 10 unit property. We're talking about one property with one folio number that has multiple units, right? So it could be a 5-unit building, 6, 7, 8, 9, 10. There could be little buildings, or it could actually be, if it's a really big property, a really big piece of land, it could be, individual structures on there that fall under the same folio number. That would be a little bit less common because typically we're going to find them as all units part of one structure. So not individual properties with separate folio numbers. That would be under our blanket loan option. So we have two channels that we can operate on this one. The one that we were going over this morning was our Dscr hybrid option that treats it like a 1 to 4 unit property, pretty much. I'm not going to say exactly because it does have its own set of guidelines, but they follow very closely the 1 to 4 unit property guidelines, which means that unlike commercial conduit options, zip code and population density is not considered as part of the equation. Whereas in the commercial option, they will not originate the loan if the population density falls below a certain threshold. So that is key, because how many times have you reached out on a property like this? Only, seems a great deal. DSCR is like 2.2, borrower's credit score is 750, low LTV, only to be told, sorry, there's only 80,000 people per square mile or whatever it is that they have, and it falls below the minimum, and they just can't do the loan. So we have the option and the workaround for that. So again, the DSCR income guidelines is what really allows this program to shine, right? It's very easy to qualify. Minimum 1.0 DSCR for most options, but please note that these are non-QM. This is a non-QM product, and all guidelines are specific to the investor. For most of these options, purchases will use the lower of the current rent if occupied, or the market rent on the 1007 appraisal if vacant. Refinances will use the lower of the lease or the market rent on the 1007 on the appraisal. Now, we do have options that allow for short-term rental income to be used to calculate the DSCR, which is very unique. Could be STR revenue reports, air DNA on purchases and refinances, or bank statements evidencing the short-term rental deposits. Now, please do note, vacant units, even though they are allowed, get a 25% reduction unless it's actually not vacant because it's a short-term rental property. Some options allow for vacant units on purchases if they are rent ready. Now, please note, maximum 2 vacant units. So if it's 2 to 3 units, it's 1 max vacant. 4 plus units, 2 max vacant. So who are our eligible borrowers? Now, you will note there in bold type in red, I do have foreign nationals as an option for this program. Besides the usual citizens, permanent residents, and non-permanent residents, excuse me, foreign nationals are allowed for this program. Now, they do have to be experienced investors only with either 1 year's ownership or small multifamily management experience. So notice it's either ownership or experience. Now, it is possible to get an exception for no experience or first-time home buyers, but that will be lower, most likely lower LTV and costs. Please note there that IRAs, blind trusts, land trusts, and most other inter vivos revocable trusts are not permitted, and neither is an entity owning the entity, right? The final thread of ownership has to rest to an individual owning the LLC, for example, and not another LLC. And they do have to be US-based entities. So what type of credit and asset requirements are we talking about? Well, for the commercial option, we can go as low as 650. For our hybrid option, which has easier underwriting, we can go down to 660. And our max and our LTV purchase, max 75% on the hybrid option and 80% on the commercial option. Cash out 70% on the hybrid option, 75% on the commercial option. Please note that under the commercial option, we do have a 90% CLTV scenario that is possible with 75% first mortgage and 15% seller held second. So theoretically only 10% down from the borrower. Gifts with a minimum of 5 to 10% borrower contribution, depending on the option chosen. Some ask for 5, some ask for 10. And reserves also vary by option chosen, but typically we're looking at 3 months for a loan amount up to $1 million, 6 months for loan amounts $1 million and $1 to $2 million, and 9 months for loan amounts over $2 million, and 3 months for each additional property with a max of 18 months reserves. And last but not least, minimum property requirements. This is where some people, where they basically lose trajectory here because they don't realize that there is a minimum square footage size of 400 square feet per unit. Plus, each unit must contain a full kitchen and bathroom. So this means no boarding houses, right? A boarding house is a home with a bunch of bedrooms where they share a common kitchen, and they may also share bathrooms. It may only be a bedroom, and they may also share the living room. So boarding homes are not possible under this program. You also have to make sure that the appraisal notes that the current use represents the highest and best use for the property. That's a tricky one. Cannot be rural, even though, depending on the option, they do allow a lot of acreage, anywhere from 2 to 20 acres. This does not mean that they will accept properties designated as rural on the appraisal, right? When they check off the rural box. That's not going to work out. minimum C4 or Q4 property condition. Please also note for cash out seasoning, for being able to use the current market value versus the purchase price, you need to have 12 months seasoning. The appraisal can also not state that there are any environmental issues and no excessive nor structural deferred maintenance. And last but not least, please also note that unleased units. So, for example, if you're buying the property, it's a purchase, they could be vacant in that case. But please note, unleased units must be in lease ready condition. This means no issues needing renovation, which would then render that unit not leasable for the foreseeable future. So then they wouldn't even be able to use that income, so your property would not qualify. So please do note all of these items that we mentioned with our 5 to 10 unit property. Remember, the niches are in the riches, so I would totally recommend that you add this type of property to your portfolio of lending products.
All right. I don't see any questions here, but definitely great product and amazing opportunity with that hybrid product as well. So, thank you everybody for tuning in. Remember, we do have a new time for this, which is 12 p.m. Eastern every Tuesday, Wednesday, and Thursday for these loan officer trainings. So, we will see you all tomorrow at 12 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great day, everyone.